Yo, 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 yo. How y'all doing today? Man, it's been a minute since we pulled up on Al Gore's internet and chopped it up, man. It's been a minute since we chopped it up. Tonight, we are, let me see, do I got my stuff set up right? It been so long since I did this right here. Let me see. Nope. Hey, yeah, I do got the right screen set up. All right, so we got slides and everything tonight. Yeah, yeah, man. We got the whole shebang bang. I'm gonna say I just finished doing these slides, man. Let me say I'm gonna save these as a PDF, and then we gon' I'm gonna put them in the I'm gonna put a link to download them in the chat if you want the slides. You know what I'm saying? Y'all put a one in the chat if y'all can hear me, if everything all right, man. Let me see who in the chat. I see hit learn and share in the chat. I ain't using stream now. No. Oh, there it is. I was gonna say it should be popping up like right here somewhere, like right there. All right, yeah, it's coming up on the screen. Yeah, I see it. There you go. I see hit learn and share in here. I see the Black Al Davis in here. I see Lil Hawk in here. I see Tish in here. I see Deborah Speller in here. Deborah Speller is in here. Let me see. Where do I want to save these at? Let's do this right here. Move this over in case something show up that I don't want to show up. Save this there. And then I see Marco in here. I see KC in here. I said Tish. I see Calio in here. Who else in here? Y'all drop something in the chat, man. Drop something in the chat and y'all share this out, man, cause tonight we got let me save these slides in the chat. Let me save these slides. Sign into chat. What you mean sign into chat? See, that's something I don't like. That's one thing I'm not liking about this doggone. This doggone. Okay. Gave me a whole nother window. It gave me a whole nother window. Now, let me see this here. So, I guess y'all like Tim. You ain't did this in a while and you still ain't organized. You still ain't organized. I told you I just finished doing the slides. I said, you know what? I want to have some slides tonight. I told you I just finished doing the slides. So let me that's Google Mail. I want Google Drive. On Google, my Google Drive. There you go. All right, so I'm gonna put these in the same folder as the art of reading price action. I'm gonna put these in the same. No, I'm not. I'm not gonna put them in there. I'm gonna make a new folder. New folder. How to use time and price. Create the folder. Share the folder. Anyone with the link. Yes, anyone with the link. Copy the link. Done. Now add the file in the folder. It's going to be documents. It's going to be how to use time and price PDF right there. Uh-oh, where did it go? How to use time and price. Let's see. Uploading. Boom. Okay, so now, somebody do me a favor. All right, somebody do me a favor and pin that message to the top. Okay, that message that's pinned at the top of the chat, right? Somebody do me a favor, click that link. Click that link and let me know if you have any issues downloading the slides, right? Like, let me know if you have any issues downloading the slides, right? And then we gonna go ahead and get into it. So tonight, as y'all see, we are discussing how to use time and price. How to use time and price dealing with the ICT concept. Y'all like my little Photoshop skills. Y'all like how I be doing my Photoshop, right? Y'all like how I got the championship belts with the time and price there. You know what I'm saying? I was looking crazy standing in the backyard. I'm just standing back there with nothing in my hands. Like, ain't nothing in my hands when I'm standing there. This is let me see if I have the picture. Okay, it works. Appreciate that, Marco. It works. All right, if I come to downloads right here. See this right here? Right. We're gonna get to what I'm talking about in a minute. Y'all know how I do. Y'all done got me all off track. Uh-oh. All right. View. Let's go to extra large icons. That's it right there. That's the picture right there. That's the picture right there. And you see, like, these, I got these belts. I think I got these belts right here. These are the ones I end up cutting out. This picture right here to use for that. But that's it right there. Right? That's me just standing in the backyard like that, right? Just standing in the backyard like that right there. Looking crazy. You know what I'm saying? And then that's it though. Got the belt with the little ICT logos on there. You know what I'm saying? Then I put time. I just slapped time and price on there. I ain't try to make it real pretty. I just slapped time and price on there. That's it, man. That's it. That's it. I be doing too much. I be doing too much. Anyway, it's good work. A lot of slides. Marco says a lot of slides. So let me start running my yap and get to it, because it's a lot of slides. Aranya Grande, heavyweight champion of the world. Say the green belt looks real on your arm. Yeah, I know. The green one was a little bit. I put a little more effort in the green one. The black one, I just kind of slapped that on at the last minute. I slapped that one on at the last minute. I was like, because I had a different belt on there, and I ain't like how I was looking. It did, so I just slapped that one on there. I ain't feel like putting, like, the green one. I put a lot of effort into it to make it look real. But by the time I got to this one, I had another belt. It was this same belt, but it was from a different picture, and it wasn't looking right. So I ended up just slapping that one on there at the last minute. All right, so let's get to it, man. How to use time and price. Now, we gonna open up this slideshow. All right, opening up the slideshow. Make sure y'all can see the slideshow. Oh man, look at me floating in the air. I'm floating in the air on the slideshow. Hold on, let me fix that. I don't like how I'm floating in the air right there on the slide. I'm gonna take me off. I'm gonna take me off because I don't like how I'm floating in the air on the slideshow. All right. So, how to use time and price. Now, just like anything, right? Just like anything, you want to understand the lingo, right? We're not going to go through all of the lingo tonight, but I'm including the lingo. I don't like how y'all can't see me. I don't like how y'all can't see me at all. $17.50. All right. Remember that $17.50. Okay. So we ain't gonna go through all the lingo tonight, but I got some lingo in here for anybody who you might be new to this. You might not be, you know what I'm saying? You might not be part of the gang, and you pulling up for the first. Hey, where y'all went? I see the chat, but I don't see y'all. Hold on. I see the chat, but I don't see y'all. Oh, I know why. I know why, cause it pulled the chat out. It put it pulled the chat out to the side. That's what happened. It opened the chat up inside of another window. That's what happened. Okay, I'm cooking with Crisco now. I think I'm Gucci. All right, let's get it. So, the only lingo that we're gonna be focusing on, right? Like I said, I got the lingo here just in case somebody don't understand like all the lingo. On lingo we gonna be focusing on, right, is the lingo's about time, which are the kill zones and the macro windows, right? So what is a kill zone? A kill zone, if you look right up here, a kill zone is a specific time during trading sessions when the ICT concepts are most probable, right? Y'all already know when it comes to ICT concepts, you hear people all the time saying time and price, time and price, time and price. But it's very few times when people break down how to mesh time and price together. And, you know, and every now, I ain't gonna say every now and then, a lot of times Michael himself, he makes it very vague, and then he be dropping gems in between all of the babble, you know what I'm saying, to separate the wheat from the tare. You know what I'm saying? To separate the wheat from the tare, like the people who really want to put in the work from the ones who just looking for the TikTok trainers, the 60-second trainers, right? So you need to understand when you're trading these concepts, right, there are specific time windows when they are most probable. Okay, those time windows when they are most probable are called kill zones, right? Again, it's specific times during sessions when the ICT concepts are most probable. And inside the kill zones, you have these slices of time called macro windows, right? So what is a macro? First of all, a macro is look right here, right above me here. Macro is a set of program instructions that run at a specific time during the kill zone, right? So a macro is a set of instructions that run that tell the algorithm, right? Mr. IPTA, you know what I'm saying? IPTA, see the next, y'all can't see it, I'm in the way. If I move me out the way, let me move me out the way. If you look at right there, IPTA is the intrabank price delivery algorithm. That's the algo, Mr. IPTA, right? The macro tells IPTA to do something, right? The macro tells IPTA to do something, right? Here are what does it tell IPTA to do? Well, first of all, let's talk about the kill zones. Here are the kill zones, right? So you can choose what time of day. The futures trade for 23 hours a day. They go from 5 p.m. Eastern Standard Time all the way through, 6 p.m. Eastern Standard Time all the way through the next day to 5 p.m. Eastern Standard Time. And then there's a halt between 5 p.m. and 6 p.m. Eastern Standard Time. And then they open back up again. It does this Sunday through Friday. And it's closed on Saturday, right? So Friday evening at 5 p.m. it closes. And then it doesn't open back up again until Sunday evening at 6 p.m. Right? Closed on Saturday. Right? Closed on Saturday and Sunday, and they open up Sunday evening. All right? So 23 hours a day, you can choose what time you want to trade in. I trade the New York session, right? So I know more information about the New York session. I know more information about the kill zones, the macros, all of that. I'm very familiar with the New York session. But since price is fractal, right, all of the concepts work during all of the time, all of the kill zones, but you just have to understand the nature of those kill zones. The Asian kill zone, right, it's known for having small ranges or consolidating, right? Every now and then it trends, right? Every now and then it trends because price is fractal. We'll get into how price moves, right? London kill zone, it moves more than the Asian. In the New York kill zone, it moves more than both of them. Why? Because it's the U.S. indices, and the U.S. indices trade during the New York time zone. During the New York session, right? All of it trades during, so all of the bulk of the volume is happening during that time. That's why tend to be larger ranges with the New York session. That's why I like to trade the New York session, because that's when, as a day trader, you want to see that volatility in the larger moves, okay? But these are your kill zones. So these are the times when you can decide when you want to be sitting down at the chart trying to engage with the market. You want to be doing it during a kill zone if you're using the ICT concepts, because this is when the concepts are most probable. Okay? Now, the macro windows, right? I don't know of any macro windows. I don't know the macro windows in the Asian, so I ain't going to pretend like I do. I know 2 macro windows during the London. It's 150 to 210, 250 to 310 a.m. Eastern Standard Time. Everything is Eastern Standard Time, right? So these are macro windows. What happens during macro windows? Macro windows, during a macro window, the macro will kick in and the price will seek liquidity and or imbalances, right? So it's going to seek liquidity or imbalances, right? And typically it will begin to spool, right? Especially if it's seeking liquidity, it will begin to spool. And if you don't want to know what spooling is when it just starts to run in one direction without really retracing. It's going, it's running. It's just continuously running, right? It ain't got to be a pow. It don't have to be like a pow, but it's just continuously running. It's just either up, or down. It's not going up, then pulling back down, up, then pulling back down. It's spooling. It's heading toward that liquidity or imbalance. And it happens during those, what's up, Lump? It happens during those windows, right? And these are your macro windows right here. Now, there is I'm gonna drop a little gem here. It's not in the slides. So if you're a notey note taker, take out your pens and paper. Time to get your crayons and your pencils, right? So there is a, I don't know if it's called a lunch macro. I don't know if it's called the London close macro. I don't know what it's called. But there is a space and time when you're going into the lunch session, right? So starting at from 11:30 forward, right? So we're looking here. We're going from 11:30 forward. Matter of fact, let me see if I, go back. See if I can exit out of here real quick and pull up my chart. Right? So going from, let's just find 11:30. Right? Come over here. 11:30 right there. Hide all this other stuff. Okay. So this is right there. It's 11:30 right there. Okay. Then we're going to go to a 1 minute chart here. All right, so we're going to a 1 minute chart. Now, I gave you the characteristics, right? I gave you the characteristics of what the macros do, right? Now, this is, so macros, they're either going to seek out liquidity or imbalance during those windows that was mapped out. Now, for this, I'm going to call it the lunchtime macro. Don't run around and say, Tim said it's called the lunchtime macro. That's just what I'm calling it. I don't know the name of it. But this is the characteristic of this special time. You know what I'm saying? You want to know the characteristics of time what you should be looking for during these times. Okay? So from starting at 11:30, right? From 11:30, right? This is 11:30. And going that way, once price is going that way. So at 11:30, what you want to do, you want to look back. Just say if you're, let's just say if you're bullish or bearish. We're gonna count both of them, bullish or bearish. We don't even care, right? Bullish or bearish, it don't matter what you are, right? So this is 11:30 right here, right? So what you want to do, you want to look back, bullish or bearish, you want to look back, and wherever you get to the first high or first low that was made after 10:30 a.m., right? So you're looking for from 11:30 going back toward 10:30, right? 10:30 is like right over here somewhere. You want to look for the first high, right? First swing high. There's swing high. Actually, there's a swing high there, but this one is more predominant, right? This one right here is like part of a little consolidation right here. But, right, we got this high, we got that high there, then we come down, we make a high, and we come down, kind of consolidate there, and then we start dropping down right here at 11:30, right? So, if you're bullish or bearish, right? So let's just say today we know price was going down all day, so we bearish. So you would be looking at the first swing high that was made after 10:30, right? Made after 10:30, and you're going to look for that to be attacked, right? Swept, taken, and then you're going to look for a move. Right, so you're looking for a Judas, right? You're looking for a Le Judas from 11:30, and you want to see the Le Judas happen to the first high or low that's made after 10:30. So if you're bullish, you're looking for the fake up and then the displaced down, and you're looking for opportunity to trade off of that Le Judas, right? So in this case here we go. We got led you that's displacement, imbalance, trade back here, right? During lunchtime there, trade back where? Into that fair value gap, into that breaker, and price goes down. So that's the characteristic that you're looking for that lunchtime. Is it going to happen every day? I'm not saying it's going to happen every day. But if you know what to look for, you know the signatures to look for, then you can engage with the market educatedly. Okay? That's the extra gem that I threw in there that's not inside the slides. Now, back to the slides. Okay. IPTA, right? We talked about IPTA. IPTA is the algorithm. Now that's time, right? Time is king, right? Time is king. Understanding when you should be sitting in front of your charts. Here go the kill zones. Understanding what happens during those kill zones, right? You have macro windows, times when price is going to be doing something pre-programmed. So you can decide, how do I want to engage during this time, during this kill zone, right? Time is king, right? You want to wait for time. And then once the time happens, then you're looking for the IPTA, the signatures by IPTA. The signatures in what? Price. Who delivers the price? IPTA, the intrabank price delivery algorithm. IPTA is the market maker. IPTA is the price engine. IPTA is the algo. And IPTA moves in a very specific way. Right? IPTA will consolidate, expand, reverse, retrace. And then once it does those, it will deliver. So we have consolidation, expansion, retrace, and deliver. Can y'all see my get out of the way thing? I'm looking at the, yes, y'all can see my, yes, right? It will consolidation, expansion, retracement, and deliver, or it will have consolidation, expansion, reversal, retracement, and deliver, right? So the first, what we was just talking about when we looking for lejudes is going to be based off of the consolidation, expansion, reversal, retrace, and deliver, right? Because you're consolidating, right? And then you getting the fake move. Remember I said if you're bullish, you look for the fake move up, right? That's expansion. And then you want to see it reverse and come back down through the sell side. Then after it make that displacement, then you want to see the retracement. Remember we said it retraced back up into the fair value gap, back up into the breaker, and then deliver, sell off, and go down below some old lows or go up above some old highs and distribute or offset, right? So, and other elements in price that you can look for, you want to know how to pair things together, right? And expansion, right, can be paired with order blocks. Retracement can be paired with fair value gap, like imbalances. Reversals can be paired with liquidity pools, meaning stops above old highs and lows. And consolidation can be paired with equilibrium, right? Because where do price tend to consolidate? At 50%. What is 50%? Equilibrium. You're not in a premium or discount. So when you start to see price consolidate, you can say, hey, we're at some type of equilibrium. We're at some type of fair value. I don't need to do anything right now. I need to chill because I don't want to be trying to look for trade setups while we're consolidating, because the price is just accumulating, is generating liquidity right now. And I don't want to be the liquidity. I want to attack the liquidity. Okay? So when you know what to look for, right? You know how to engage the market educatedly. So if it's consolidating, you can say, hey, we're at some type of equilibrium. And then you can go in and do your deep dive. You can pull out the Timinucci's and try to see where the range is that you're consolidating inside. That's not what I'm talking about here. Go back through the old live videos and figure out what a Timinucci is, right? Then expansion, when price expands away rapidly, right? When you see it expand away, then you say, I should be looking for an order block. I don't care if it expands up or down. I should be looking for an order block. If it expands away, I need to be looking for an order block. Because when it decides to reverse or retrace or do something with some kind of, when it does all of this, I now have a key reference point that I can use to aid me in my entry. When I see that expansion, bless you, I think when I see that expansion, I should be looking for an order block, right? And then if price runs, hit stops, and wicks off of them, you can be saying, oh, I could be looking for a reversal, because the reversals are combined with stops runs inside liquidity pools. If we run above highs or below lows and reject off it, like a quick stop run, long wick, you can be like, oh, wait a minute. We might be coming up on a reversal. Not saying it's going to be, but signatures. You're looking at signatures and price. A reversal may be in the near future because we just ran stops. We didn't displace through those highs. We didn't displace through those lows. We ran stops. Hit it, backed up off it, rejected, long wick. Look at the wick. He's proud of that wick. Has a very long wick. He's proud of it. And then with price, it displaces away, give you a fair value gap. Once you see that fair value gap, then you can say, hey, there's a possibility of a retracement back to this fair value gap. Will it always come back to the fair value gap? Sometimes it'll be a breakaway gap. Sometimes you only get an institutional order flow entry drill. Sometimes it won't come back to it at all. But if it's there, you can be anticipating a retracement. You hear me? Right? So that's one thing about price. That's one characteristic. Those are different, not one, but those are different characteristics of price that you want to keep in your mind when you're watching the charts, right? One of the most important things about price is the open, high, low, and close. Everything has an open, high, low, and close. The open, that's the first agreed upon price for that period. Notice I said period, because all aspects of price has an open, high, low, and close. The high is the highest agreed upon price for that period. The low is the lowest agreed upon price for that period, right? He's proud. He proud of that wick. The close is the last agreed upon price for that period, right? Why am I stressing for that period? Because all aspects of price, not just one candle, right? Because the candles represent a period of time. If like a daily candle looks just like a 1 minute candle, the only difference is the amount of time in minutes wise that's contained within that open, high, low, and close, right? On a daily candle, there are 23 hourly candles inside one daily candle, right? So you extrapolate that out to see how many 1 minute candles are inside a daily candle, right? So if you got 1 minute, it's 60 minutes in an hour. There's 23 hours in the trading day. So 60 times 23, that's a 0. 6, that's an 8. 1, 6 times 2, that's 13. So that's 1,380 1 minute candles in a daily chart. Somebody get a calculator and see if my math is mathing. I just did that math on the fly. Somebody get a calculator and see if my math is mathing. Right? There's 60 minutes in an hour, 23 hours in a day. Look at that math. That's Boyd Anderson High School. That's Boyd Anderson High School right there. It's 1,380 1-minute candles inside of a daily candle. And every last one of them has an open, high, low, and close. Right? Every day has a Asian session, a London session, and a New York session inside that daily candle. Right? Every session has an open, high, low, and close. Right? So everything has an open, high, low, and close. Every aspect, right? Candles, seconds, minutes, hours, sessions, days, weeks, months, years. All elements of price action got an open, high, low, and close. And that's, you don't need indicators. You don't need anything on your price, on your charts besides the candles themselves, right? Yes, he was from Ely. Ely got spared. They spared over there, Ely. Right? So that's all you need to focus on. The open, high, low, and close for all aspects of price, right? Sessions, days, but however you're trading, the open, high, low, and close, right? Now, that's another thing about price, another aspect of price. The open, high, low, and close is the most important thing about the price, and you're looking for these different, you got the open, high, low, and close, you got the way price moves, consolidation, retracement, reversals, expansions, right? All of this right here, in all these aspects of price, right? There's also something called I don't have the first slide in there, but it's called the power of three. It's missing a slide, right? But it's called the power of three. And that's I could have swore I put that in there, but I guess I didn't. Right? It's called the power of three. Let me fix that right now while I'm thinking about it, because if I don't, that's gonna drive me crazy. If you download them slides already, you're gonna have to re-download them. Let me see, power of three. Let me put that slide in there. All right. So put that right there. I know I put it in, I must have deleted it out. Hit, okay. Hit save. Yep, because I remember when I did it, I had to readjust. I had to readjust that. I mean, I had to adjust it just like that right there. Last time I did it, I remember doing that. Okay. This what happened when it's live. I can't cut this out. ICT concept. How to use time price. Yes. Save over that. Hey, why did it close my slideshow? Whoa. What just happened? Y'all hold on, man. What in the... Wait a minute. Oh, wait a minute. Wait a minute. Why did it... Y'all already know how I do. I'm locked in now. Cause I just did this and it took it off the... It didn't save it. Let's see. Yes. Okay. All right. So that's in there. That's that. There. Okay. That's that there. Okay. All right. Sorry about getting off on that tangent just then. And now I need to move that. I need to add this. Upload a file. How to use time and price concept open. All right. So now that's got the slide in there. Okay. I'm cooking with Crisco again. Power of 3. There's another aspect in price that's called the power of 3. The power of 3 is accumulation, manipulation, and distribution. Right? So accumulation, manipulation, and distribution. Now, accumulation is going to happen at or near the open, right? If you bullish, it's going to happen at or near the open, right? If you bearish, it's going to happen at or near the open, right? When price is bullish, right, it's going to be building up long positions during this accumulation. It's engineering liquidity. It's building up long positions during this accumulation. If you're bearish, it's building up short positions. It's engineering shorts when you're bearish, right? So the accumulation is the same as, what was the other word when we just sat there? Consolidation. When I said we were engineering liquidity, right? We're consolidating. The accumulation can happen during that consolidation phase. Is it going to always just be a tight consolidation phase? No. It can be a broad consolidation phase, but it's going to be some type of range that the market stays in, where it's letting longs and shorts build up above and below price action, and it's accumulating, right? And it happens at or right at or near the opening price. Remember I said everything has an open, high, low, and close. So at the open of that hour, at the open of that session, at the open of that day, at the open of that minute, at the open of that candle, the accumulation is happening at or near that opening price, right? Then you got what they call manipulation, right? Manipulation is when price expands in the opposite direction of the draw, right? Remember back here when we was talking about accumulation, expansion, reversal, retracement, and deliver. So you got your accumulation or your consolidation, right? And then in this case with the manipulation, you're expanding in the opposite direction of the draw, right? So your expansion is manipulating. So when you're long, you're engineering short liquidity by forcing breakout traders into the market, right? Because when price breaks down, you have people that get in on breakouts to the downside, right? So you're engineering short liquidity and you're neutralizing people who was in the market on longs. They got in early. They're getting stopped out. So on that manipulation, they're manipulating people out who was in properly. So how do you get manipulated out? How do you get forced in? By going below or above previous lows or highs. So when you're looking for the manipulation, you want to make sure you see price. If price is bullish, if you're looking for anticipating manipulation, you want to see price running stops below the market. That's how you know that it's manipulating people in and manipulating people out, right? Running those stops above or below the market. looking for those stop runs, right? And when you see those stop runs, what do we say we pair with stop runs, right? Stop runs are paired with what? Reversals, right? And what do we said this was? We had consolidation, expansion, reversal, right? A consolidation, expansion, reversal. So once we see the manipulation, we run those stops. Now we're looking for the reversal, right? Looking for the reversal. Why? Because we've manipulated people out and in. The people that was in and they were right took their head off. People that wanted to get in and they was wrong got them in. Now they're stuck underwater and they got a decision to make. Do I just get out now or do I just keep bleeding? Okay, so we're looking for those stop runs during that manipulation, right? Then you get the delivery. The delivery is on the opposite end of the range, either below old lows, where you deliver, distribute, offset, right? Because any short positions that you accumulated up here, you're gonna deliver, distribute, offset below old lows, right? So that's your target, getting back to old lows. If you're going long, your target is above old highs, getting back to old highs. So you want to be looking for those old highs. That's a little preview of what we gonna be getting into in a minute. You're looking for this stuff, right? Now, just like open, high, low, close, the power of three, accumulation, manipulation, distribution, it can be seen in all aspects of time, in individual candles, in minutes, during sessions, during hours. It's when you understand how the accumulation, manipulation, and distribution works, you can see it through price. You can look for times when you can look and see, okay, we were consolidating there, and then price moved down. After it ran those stops, it moved up, then retraced back into the range and went up and delivered above these old highs. We had accumulation, manipulation, then we had distribution up here above these highs. Then we went back into some accumulation, and then we manipulation, distribution. You can see it in the charts. You know what to look for, right? And you're not looking for it to happen every session, because the accumulation, manipulation, distribution can happen over an entire day. It can accumulate in the Asian, it can manipulate in the London, and then it can distribute in the New York AM. Or it can accumulate in the London, it can manipulate in the New York AM, and then distribute in the New York PM. It can accumulate in the New York PM, manipulate in the Asian, and distribute in London. It can happen over multiple sessions. IPTA don't care about our man-made stops that we have. It just knows what it did the last time it was running, and now that it's running again, it's going to continue to refer back to these, these signatures and these little clues that is leaving itself in price, right? So you can see this AMD throughout all the aspects of price, and that can help you figure out, how is this hourly candle made? How is this daily candle made? You can see the signatures of accumulation, manipulation, and distribution. Is every candle made off of accumulation, manipulation, distribution? No, it's not. But when you see it present, you can say, aha, I know what that is. I know how to interact with that. Bingo, right? So you always want to follow the big money, right? What do you look for evidence of institutional sponsorship? What do you look for, right? Gang, gang. What do we look for when we're looking for the evidence of institutional sponsorship? Right? Can somebody put in the chat, what are we looking for the evidence of when I say follow the big money? What are we looking for? Can someone put it in the chat, please? What do little Tim Rogers call it when big money steps its foot in the pool? What happens? Not spooling. It starts with a P. What happens when big money steps its foot in the pool? What happens to price? There you go. Pow! Pow! That's what we looking for. We looking for the pow! We want to see price move. Right? There you go. It's displacement with a fair value gap. J-Rock, it's displacement with, you know what I'm saying? Displacement. This expansion with a fair value gap is displacement. Yes. Expansion with a fair value gap. That's displacement. Right? So we looking for the pow! Right? And what other things we looking for besides the pow? These are, you know what I'm saying, straight off Michael's slides, the things in price you want to be looking for, the signatures in price you want to be looking for to let you know that institutional sponsorship is in the building, right? So long and short, it's same thing, but it's just broke down for long and short, right? So displacement, like J-Rock was just saying, displacement, right? So displacement is when we got that expansion paired with fair value gaps, meaning price is moving heavy in either buy side delivery or sell side delivery. It's not efficiently delivering in both ways. It's just moving in one direction quickly, right? You're looking for like reversals on the higher time frame. You're looking for returns to fair value, meaning once you hit some liquidity, expand it up, now you're looking for an opportunity to return back to at least equilibrium, come back to at least fair value, right? So you're looking for opportunities. When you see that expansion, what is it leaving behind? Is it expanding to some sell stops and I can anticipate a reversal? Right? Is it going to buy stops and I can anticipate a reversal? Has it expanded and it has hit the buy stops or the sell stops? Can I anticipate a return to fair value? Right? These are signatures that you're looking for in price to, once it starts to move, to say, hey, institutional sponsorship is amiss. How do you see it? It probably left an order block back there when it expanded. It probably left fair value gaps back there when it expanded. When it hit this buy side liquidity or hit that sell side liquidity, it might have rejected off of it. So now it's showing a sign of a possible reversal. That possible reversal said, hey, we can at least go back to fair value. We can at least go back to equilibrium, or we can even go back down. Once we get to equilibrium, is price still showing me that it wants to get back to that fair value gap? Is price still showing me it wants to get back to that order block? These are all the things you can be looking at in price to say, ha ha, I know that signature. I can engage with you, price, educatedly, right? You're going to be looking for, right, like a move to discount or premium, right? When you're in a premium and then you see that possible reversal and then you see a break in market structure, you can say, hey, there's a fair value gap down there in the discount. I can anticipate that move to the discount. If it's moving to the discount, there's not only a fair value gap down there, there's an order block down there. So when it get down there to the discount, I can be a buyer because that order block down there, job is to stop it from going to them lows. And when I get in at that order block, get in at that fair value gap, I got my stop below them lows. It's not going to take me out because it already manipulated the people out during the manipulation phase, and now I'm getting in when the smart money is getting in, and I can ride it up and get ready to distribute up here above old highs. This is flipping on the head. I can get short and in the premium and go down there and distribute down there below old lows, right? When it comes back up to that fair value gap, comes back up to that order block. Y'all see what I'm saying, right? And then you want to be looking for like short-term swing lows and swing highs where you can be pairing your exits with, right? So when it's coming back to the discount, is it leaving behind swing highs and swing lows so that when you get in, now you got a target. Oh, look at there. It left that swing high up there when it came back to the discount. So now I see a spot where there is a liquidity above the market that's ideal for pairing my exit. There is liquidity below the market that's ideal for pairing my exit. Right? You see these signatures. You say, I know what I can shoot for when it comes back to the discount, when it comes back to the imbalance, when it comes back to the order block, when it comes back to the breaker, when it comes back to the volume imbalance, when it comes back to the liquidity void, whatever PD array you decide to get in on, when it comes back to the discount or the premium and you get long or you get short, now you're looking back in price, say, hey, we left a swing high. Hey, we left a swing low. Hey, we left equal highs. Hey, we left equal lows. That can be my target. That's what I'm shooting for. Knowing what to look for in the price, right? At what? Key times during the day. When should these things play out? During key times during the day. During kill zones. When should price start spooling toward liquidity or imbalances? During macro windows, right? During the macro windows is when you can anticipate price moving faster, right? So if you want to get into trades and see an immediate reaction within 5 to 10 minutes, you can say, okay, I'm only going to look for setups that's around the just before or right as the macro window start, because I don't want to get into a trade and sit through a lot of consolidating and draw down. I just want to get in and it move. And you can do that by knowing these are the kill zones. These are the macro windows. Okay, now I'm looking for the signature. I see the signature. It's setting up on my time frame that I'm watching. It's setting up. Now I can enter because it agrees with my higher time frame, and I get in and it's going to pang. Get it? Got it? Good. Now, let's talk about another aspect of price while I sip some high quality H2O. Y'all read what that say. So, market maker buy and market maker sell models, right? They're not just fancy little drawings on the screen. This is a market maker buy model. This is a market maker sell model, right? These are a specific set of, let me read it, right? Market maker, hey, my note ain't on there, but it's a specific set of criteria that leads to high probability actions. I'm summarizing because my note, I don't have my note on there, and that's killing me because I ain't got my note. I want to read it just like I supposed to read it to you so you'll know exactly what I'm talking about. Market maker models right here. So market maker models is where's my, it's a very specific criteria that lead to probabilities. That's pretty much what I said, right? So market maker models is a very specific set of criteria that leads to probabilities. Okay, so with market maker sell models and market maker buy models, right? The way I like to remember it, right? So you have accumulation and you have distribution, right? Accumulation is going up, distribution, and when it's going down, right? On the right side of the model, right? You see both of them are shaped like this. You got the market maker buy model that's shaped like a U or V, right? And you got the market maker sell model that's shaped like a or a upside down V, right? When you split it down the middle, right, on the right side of the model, when you're on the right side of the model, you just add re to the accumulation or distribution. So in the market maker sell model, right, you have accumulation, you got initial consolidation, accumulation, smart money reversal, which is low risk sell over here. Then you get redistribution, second stage redistribution, and then you come down here to terminus and start all over again, right? With the market maker buy model, right? You have distribution on the left side, and then you got reaccumulation, second stage reaccumulation, and then you get to the end. You don't always have to have first and second stage or first and second stage. Sometimes it'll be first stage accumulation, second stage accumulation, smart money reversal. Then it'll be just redistribution and go to the end. It ain't got to always be first and second stage redistribution and all of that right there. So you got reaccumulation on the right side and accumulation on the left side, redistribution on the right side, and distribution on the left side. That's how I like to remember it. Re on the right, right? So with the market maker models, it can show you where you are in the sense of is price in a buy program or a sell program, right? If it's in a buy program, in a sell program. So if you can identify that you are, it's easier to identify once you get to the right side of the model, right? If you're more advanced, you can sometimes quickly identify, hey, this has the makings of being a market maker sell model when you're still on the left side of the model, right? But it's easier once you get your smart money reversal and you start to come back down. It's easier to identify once you get on the right side of the model. And then you know, okay, now that I'm on the right side of a market maker sell model, price has moved into a sell program. So I should be looking for opportunities to sell. I should not be looking for opportunities to buy until after I reach my destination and price shows me that it's ready to go back bullish again. So if I'm on the right side of a market maker sell model, I only need to be looking for opportunities to sell, right? Now you can scalp longs, but the more what's the term I'm looking for? Your strike rate to be better if you're selling, if you're only looking for sales on the sell side of the market maker sell model, and if you're only looking for buys on the buy side of the market maker buy model, your strike rate to be higher. You can hold your trades longer. You can have better risk to reward, like you can have a higher RR if you're only trading on the right side of the model. Okay, so these are not all, but these are like the key aspects of time and price that you want to have in the back of your mind when you're trying to pair it together. So you don't have to try to use all of these, but these are the key aspects of time and price. You have your kill zones, you have your macro windows, you have your lunchtime thing. So you got specific times of the day when you're looking for things like market maker models to form, to show themselves. You're looking for institutional sponsorship to show itself. You're looking for power of three. What phase of power of three are you in, right? Are you in accumulation? If you're in accumulation, you're not looking for trades. If you want to be trading during the manipulation or the expansion going toward the distribution, right? If you're trading during the manipulation, then you're going to be holding your trades for a shorter period of time, right? Unless you're trading on the reversal side of the manipulation leg, and that'll give you the opportunity to hold it for a longer period of time. But when you understand the power of three, you can get in. And what I mean by getting in on the reversal side is when you're getting in at or above the open price when you're bearish, or at or below the open price when you're bullish, right? And you can hold it for a longer period of time when you understand the power of three, right? You understand accumulation, manipulation, distribution, right? You understand the open, high, low, and close. You know when the New York session opened. You know when the midnight open was. You know when the London open was. You know when the open of this hour was. You know when the open of that. You know when the open was. So when you see the manipulation and you say, okay, this is the opening price. I want to be getting in above that because I'm going short. This is the opening price. I want to get in below that because I'm going long. You understand, okay, price is in a discount. I want to get long in it. You understand the equilibrium, the discount, the premium, the open, the high, the low, the close. You understand all these elements of price, of time and price, so you know what time I should be looking for. Time is most important. If it ain't time, don't be in front of the chart. If it is time, be in front of the chart, man. Now, Tim, you doing all that blabbity dibbity yabbity, the yabbity dibbity blabbing. Man, let's get on the charts and look at some candles so I can see what you talking about, man. Sure. Let's do that, shall we? Before we do that, does anybody have any questions of me while I sip on this high quality H2O? I think the delay real short when I'm using StreamYard. So, do anybody got anything? I can't see how long we've been going when I'm on StreamYard. How long have we been going? StreamYard don't show me how long we've been going. Not StreamYard, Streamlabs. Oh, yes, it do. It's over there. It's at the top. We've been on here for an hour and 6 minutes. Okay. I ain't mad at that. Hour and 6 minutes. I ain't gonna hold y'all much longer. Okay, let's get in here and let's do it. Let's look at today's price action. We're gonna go into today's price action and we're going to look at let me put it on 15-minute chart so I can get more time on here. So we're gonna go today's price action and we're going to look at the New York session today. All right, so let me get me a line. I'm put it over here at 9:30. Right. Matter of fact, I'm put it at 7:30. Now, me personally, I like to start watching price at 8:30 because I trade the U.S. indices. In the U.S. indices, they usually have news embargoes at 8:30. News usually drops at 8:30, so I like to start watching at 8:30. But the official time for the kill zone is 7:30. Right? I think that's more so like a Forex thing. But I like to start watching it at 8:30 because we have news during that time. So I'm gonna put the thing at 8:30 right here. Put a thing at 8:30. 8:30. All right, and then I'll put one at 9:30. 9:30. Don't worry, I'm gonna make these candles bigger. I'm just marking out these little time windows here. All right, so we got our 9:30. Okay. And then now let's go in here, put this on 5-minute candles. We're gonna go in and block out our times. Okay, so this right here, we're gonna go from 9:30 over to 4. Oh, that's Monday. I need to get on Tuesday. I'm over there on Monday. 9:30. To 4. Okay, now I need to move all these down over here. All right. Right, 7:30. Okay. All right. So, all right. This is the opening of. This is the macro. Well, I mean, it's the open of the kill zone, right? So we're gonna go over here. 7:30 over to. All right, I'm just gonna put this over to. I'm gonna put this to 11:30. All right, I'm gonna put this to 11:30 right here, and then I'm gonna put the lunch one. All right, so. Right here, gonna be. Kill zone. AM kill zone. All right, we're gonna do 7:30, 12. All right, but I just extended it over to 11:30. All right, cause I'm gonna mark the other one. I'll mark the other one from 11:30. 11:30 over to 1:30, and we're gonna put lunch. We're gonna put lunch, and then we're just gonna put in here. I'll put 11:30 to 1:30. Right, cause there's certain things you start looking for at 11:30. That's why I put it 11:30 up there, and this right here say 7:30 to 12. Right, but it's certain things you start looking for at and then we'll come over here 1:30 to 4. New York PM kill zone. All right. .30 to 4. Okay. All right. So we got our kill zones, and then now I'll come here. Say 9:50 to 10:10. All right. Macro 9:50 to 10:10. All right. Oh, did the text. Need this to be. All right. All right. Okay. And then that's the lunchtime right there. Then that's the special time during lunch. And then over here. All right. When did we get advertisement during live stream? I don't know. I don't know. What's 112, Lump? What's 112? I don't know. I guess since I've been going so long, YouTube say, "Hey, I'm gonna give y'all a ad break." He been flapping his gums too much. How long you were? Oh, okay. All right. So that's uh what is it called? What is it called? One of them is market on close. One of them is market on close. Okay. So just macro 315 to 445. Yeah. So three. Just mark it on close. Mark it on close macro from 345 to 4. I'm gonna put 445. That's 345. Three 45 to 4. Alright. Then it's a settlement macro. That's a settlement. Ah. Settlement macro from 350 to 4 o'clock. Alright. These are different macro windows. Okay, so now, so this is our session. This is our New York session right there, right? That's our New York. That's our total. The total yellow part is our New York session from 9:30 to 4, right? Then we have our kill zones where you're looking for signatures in price, right? You're looking for signatures in price. This is the New York AM kill zone. This is during lunch. And then this is the New York PM. So during, you pick your time that you want to be in front of the chart looking for signatures and price. Okay, now this all ties into, right? You got your higher time, you got your TDA on the chart, right? You got your top down analysis on the chart. Okay, so I just popped on my top down analysis that I have marked out from over the weekend, right? Let me hide the stuff that I just did, right? This is the stuff that I just did right here. This is my time. This is my time, right? So I'm gonna hide my time. I'm gonna lock my time. Then I'm gonna hide my time, right? So this is my time, right? So now this is my TDA, right? Let's go up for a second. We're gonna go up, right, to a week. So because this is everything you do. You do your TDA, right? So I come to the charts and I'm looking at. All right. So for weekly, I'm gonna come in here and I'm going to delete this off first, right? This is from this week, right? So I come in here for doing my TDA. This is my weekly PD arrays that I marked out, right? You always want to have your anticipatory reactionary points on your chart, right? You start with your TDA, right? So on my weekly time frame, this is what I got marked out, right? You see that says monthly, because on the monthly, the only thing I marked out on the monthly was the monthly high and low. I chose not to mark out the monthly consequent encroachment of the wick, right? Chose not to mark that out. I marked out just the high and low on the monthly, because last month in August, I was watching this bullish order block, and we hit the bullish order block here and got a nice rejection off of it, right? So this month I've taken the bullish order block off, and I chose not to mark out the consequent encroachment of the wick, but that's all I marked on the monthly, the high and the low. Weekly, right? This, I got the portion of the fair value gap that's still left open. This is the BISI that we had marked out last week. We traded down close to consequent encroachment of the BISI, hit that during the month. We came down, hit this monthly order block, and expanded back up, created this BISI, traded back down to close to consequent encroachment of the BISI, and wicked up off of it. Okay, marked out the remaining portion of that BISI, right? And I left the bearish weekly fair value gap on there from last week, because we didn't get up to that fair value gap, so I left it there. We're still in between the tail of two cities. We're still working the discount BISI, and we still have not reached the premium SIBI. And I marked out the consequent encroachment of last week's gap. Why did I choose to mark out the consequent encroachment of last week's gap, and I didn't choose to mark out the consequent encroachment of the monthly gap? Because I'm a intraday trader, and the consequent encroachment of last week's gap is more pressing to price for me, because it's closer in proximity than the consequent encroachment of the monthly consequent encroachment of the wick. And I'll show that visually here, right? If I go there to there, consequent encroachment of the monthly wick is there, and it's farther below the consequent encroachment of this weekly wick. So we closed here on the weekly, right? So I'm just looking at prices. I'm looking at PD arrays that's in close proximity of this. I won't start paying attention to the consequent encroachment of that monthly wick unless we start trading down through the bottom side of this BISI. Then I will start to annotate that there. Right now I just got it in the back of my mind. Then I'll start to annotate that there, right? Yeah, we get into it. We just going through our TDA right now, right? Now, for the daily chart, right? On the daily chart, I have a daily fair value gap marked out, right? Got a daily fair value gap marked out, and I have the daily high and low marked out, right? And that right there is the consequent encroachment of that wick. And that's pretty much all I marked out for my TDA. I don't think I marked anything for 4 hour. No, I don't have anything for the 4 hour. Nothing on the 4 hour was pressing for me to mark out. Now, one thing I do when I'm doing my TDA, right? If you notice, so on the weekly, right? On the weekly, I have a weekly fair value gap up here and a weekly fair value gap down there, right? Then I got a weekly high and a weekly low. Okay, with my time frames, right, with this monthly high and this monthly low, the only reason why I have this weekly up here is because that was up there from when we rolled over from last month, and we still haven't touched it, right? And also, if we get to that high, I want to know how far past that high can we go, right? But all of my weekly stuff, for the most part, is inside the range of my monthly analysis. And then when I go to my daily, right, all of my daily information, right, is inside my week. This is the lowest area of my weekly analysis here. So I have a daily fair value gap marked out inside that weekly fair value gap, right? And I just have the daily high there because I don't have any daily fair value gaps to mark out up here inside my weekly PD rate from the SIBI on down, okay? And then 4 hour didn't give me anything. So my 4 hour, I don't have any 4 hour PD rate up here inside my daily high and low, right? There is a 4 hour BISI right here, but because I have a weekly fair value gap down here and a daily fair value gap down here, I'm not bothering marking out this 4 hour BISI right here because we have higher time frame PD arrays below it, so I'm not anticipating buying off of that 4 hour PD array. I only try to mark the PD arrays where I'm looking for some type of reaction, right? And the only reaction I will be looking for this is for this to become an inversion fair value gap to sell down to these PD arrays down there, because right now I'm anticipating price to draw down into these, right? Do we draw down in them to go back up? I don't know, don't care. I'm just anticipating price to draw down into them, because if you look at on a 4 hour time frame, we've gone up and we have a bearish break-in market structure right here. And once we got that bearish break-in market structure, price has not been able to break back up, right? So we got a bearish break-in market structure there, right? Once we came down here, we took that low, came down here, took that low, right? Bearish break-in market structure there, and then we are dropping down, right? We continue to drop down, came down into the weekly fair value gap. We came down into the top portion of the weekly fair value gap, but we haven't been able to break back up. So we've just been working inside the premium of that fair value gap, right? So if price is still heavy and it's working inside the premium of that fair value gap, where do we sell? We sell from a premium. So we're working inside the premium of this weekly fair value gap. And if we sell from in a premium, right, and price is still heavy, which is showing it's still heavy, then that's why I anticipate price drawing down into the bottom of the weekly, bottom portion of the weekly, and maybe into that daily fair value gap, because we've already traded into the weekly and we have a daily fair value gap down here that we can trade into, right? So that's my top down analysis of price. That's all I have marked for my top down analysis. Now we can jump down to, hey, let's go back to 60 minutes. Let's go over to the end, and then we're gonna, no, let's go to 15 minutes, and then we're gonna mark out stop time at 4 o'clock. That's 4 a.m. 4 o'clock. Right there. End of the day. So there we go. Hey, look at there. I just noticed that we came down to that daily fair value gap. Like magic. Okay, so now let's turn on our time. What is this? What is that rectangle right there? I don't know what that rectangle is for. I don't know what that's for. I don't know. What is that? It's showing that it's right here. What is that? It just was something. I don't know. I guess I accidentally hit something. Sorry about that, y'all. I'm trying to figure out what that was for. Okay, so let's turn on our time. All right, so we got our time on. Now these are 1 minute candles. So remember, you won't be all the way down on the 1 minute right off the rip, right? We have our top down analysis on there. We're anticipating price to draw down into the weekly fair value gap in the daily. The only thing I got showing on this time frame is the daily, right? Because that's the weekly there. So if we go to the, I'll let it show all the way through. Because I don't like when it be like overlapping a lot. I don't like when it be, see how it look when it be overlapping a lot. See the whole big old, like that's the whole green part right there. All right, so that's the daily down there. That's the bottom half of the weekly. That's the weekly low. Okay, so now got all our TDA on there. Now coming to the 7:30. Right, coming into the 7:30 macro window right there, right? So starting at 7:30 macro window, we're coming in here, and time and price. Talk about, God dog it. Let me move all this down so we can see our stuff. God dog it. God dog it. Why does it keep? Oh, I know what I'm doing wrong. Like that. Okay. All right. Now. Okay, so now coming into the new, if you trade before the 9:30 open, right? If you trade before the 9:30 open, now you're inside the kill zone now. We're inside the kill zone. So you say, hey Tim, I want to trade the 2024 mentorship model that Michael has been talking about, right? So the concept behind the 2024 mentorship model, you come in and start watching price at a certain time of day. You know what I'm saying? 7 o'clock, 8 o'clock, 9 o'clock, whatever time you come in, right? So now starting from like 7 in the morning, right? So starting from like 7, we just going to put a line over here, just say start from 7 in the morning, right? So from 7 in the morning, you're looking for price to establish a range, right? You're looking for price to establish a range. You're looking for it to make, relative high probability equal lows or equal highs, right? Look for price to engage with them and show signs of wanting to, showing signature in price, right? So you say, I want to trade that model. If you want to trade that model, now you know what time you need to start looking, right? Okay, Tim, I don't want to get up at 7. I don't care. You don't want to get up at 7. If you don't want to get up to 8, you know to start looking from 7 o'clock on, right? You're looking for price to establish a range from 7 o'clock on, right? So coming from 7 o'clock on, you're looking for it to establish relative equal highs, relative equal lows. The high probability equal highs and lows, right? You know another characteristic of the price is, if you're looking at lows, right, you want the low on the left to be lower than the low on the right, right? Just like this low and that low, those are relative equal lows. What is that? That's a high probability relative equal low, because the low on the left is lower than the low on the right. So you got high probability equal lows right there. If you didn't start watching price until 8 o'clock in the morning, right now you can look, say, hey, I got relative equal lows here, got high probability relative equal lows there, right? I have a swing high here, right? Yes, they're relative equal highs, but this high is higher than that high, right? So I'm just looking at that as a swing high, just like I'm looking at this as a swing high, because this high is higher than that high. Yes, they're relatively equal, but I'm just identifying the high probability equal lows or equal highs, and then I'm just identifying the, like, if you looked at this, that would be, if you looked at this as relative equal highs, that'll be high probability, because that high is higher than that high. Okay, so right there you got relative equal highs right there, start after 7 o'clock with a swing low down there. So you got relative equal highs and a swing low. If you're watching price starting at 7, relative equal highs and a swing low. Okay, relative equal highs, relative equal lows, right? If you're watching price, it's starting at 8 o'clock right there. You're starting at 8 o'clock there, relative equal lows, right? Take out the relative equal highs, right? Price trading down, we come down, right? It's not giving you it ain't giving you like a clear indication that it wants to continue down, because it engaged the relative equal highs, right? But it left the relative equal lows intact, right? So yeah, oh, it took out highs, it's ready to go down. Not yet. It left the equal lows intact, right? So what's the rules of engagement? You want to see it engage with, like, if you're bearish, you want to see it take out the highs and then engage the lows and give you a setup to go low, right? We took out the highs, but we didn't, we left the lows. So guess what? You still don't have a trade yet, right? So now we're coming over here, coming to like after the 9 o'clock hour right there. We coming to the 9 o'clock hour over here, right? So what happens during this time here, right? We go up, we take out the high, right? And then we come down, right? And we take out, remember the relative equal lows that we had left over there? We left these relative equal lows. Now we got like a slew of them, right? It's more smooth down there. These are a little bit higher, but you know, relatively speaking, relative equal lows, right? Took out the high, took out the relative equal lows, displacement right there, right? Institutional sponsorship right there, right? What did we do up here? We got a consolidation, we got an expansion that took out liquidity, wicked off of the high right there. See the wick there? Stop run. What can you anticipate after a stop run? A possible reversal. So I'm looking for this to be a Le Judas. We took out the buy side, came down, took out the sell side. There's your Le Judas, right? There's your imbalance. Right, you got to imbalance left and we got to imbalance, so we can anticipate what? Retracing back to the imbalance. Retracing, the retracement is paired with what? Imbalances, right? Expansion is paired with what? Order blocks, right? So when we come over here and we expand down, what do we leave behind? Bearish order block here, right? So you got to, let's mark out the bearish order block, right? We got a bearish order block here. Right, bearish order block right there, right? We got us a consolidation here, right? We expand, what's consolidation paired with? Order block, got an order block there. The displacement, institutional sponsorship, expansion with fair value gaps, displacement, fair value gaps. Inside here, we got sell side imbalance there, right? We come down, we take out the liquidity right there, come down here, make relative equal lows. Okay, so boom, Come here, once we start trading back up, what do we make here? Relative equal lows. What else? When we said, oh, this looked like institutional sponsorship is there, because we came up, we took out buy side, we had a rejection off the buy side, showing a sign of a possible reversal, came down to engage sell side, right? Showing that price wants to go down, because after taking the buy side, took the sell side, Judas swing, right? Remember all the stuff we was looking at. When is it happening? During the kill zone. Remember, this is our kill zone up here. We're inside the kill zone right here. We're inside the kill zone. It's setting up, right? Price starts to consolidate here, right there, and expands away, right? There's a bullish order block there. There's a bearish order block there. Price retraces after we expand it, right? It retraces back up in there. So we got our consolidation, expansion, reversal. Now we're retracing, right? We're retracing. Where do we retrace back to? Back to the imbalance, back to the order block, right? In this case, the order block, the expansion left an order block and traded back to an order block, right? So we consolidated, expanded, right? Left an order block there, traded back down to an order block there, right? Consolidation, expansion, order block, right? Consolidation, expansion, order block. Does it do it at every time? No, but it's signatures that you're looking for, right? We hit our order block right there, and then we drop down after hitting our fair value gap in our order block. Boom. Where do we come to? The sell side there. Whenever price retrace back, what are we looking for as another signature to the institutional sponsorship? Right? Let's go over here and see. We're looking for, what do we say? We're looking for short-term liquidity below the market or above the market. In this case, we're bearish. When we retrace back up, what did it leave? Relative equal lows. What is that? Short-term liquidity below the market, because you're up here. Short-term liquidity below the market. What is that? A signature, right? A signature inside a kill zone. Okay? A signature inside a kill zone. Now, if I'm not mistaken, I think it may be a macro around that time too. Don't quote me on this, but I believe it may be a macro over here at 850 to 910, but I'm not sure. So don't quote me on that, right? Don't quote me on that right there. But I believe it's a macro here too, like a 850 to 9. I think it might be like one, like on every hour during the kill zones, from like the 10 minutes till to 10 minutes after, but don't quote me on that. But I think it is. But, and if it is, but see how price spools to the liquidity right here? See how it's just going down, 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 but very little, no retracement. Like this candle went back up, but it's just spooling down, right? Just spooling down. But don't quote me on these times, but I believe it is one at the 10 minutes before the hour to 10 minutes after the hour for each hour during the kill zone. But I know for a fact, the ones that I marked out, I know those for a fact to be macros learned from the concepts. Okay. So that was, if you trade before that time, see the signatures, time and price. You know the times you're supposed to be looking for stuff, and you're looking for the signatures and price. Time comes first. Okay. Now 9:30. After 9:30, we open up. Let's come here. Gonna pull this down here to the lowest point during the macro time, to the highest point in the macro time. I'll get to those in a minute. So now, coming here during 9:30. So at the 9:30 open here, right? Price is still dumping down, right? Price is dumping right here. Okay. So now, what do we talk about, right? The algorithm don't care nothing about, right, our separations and breaks and limitations, and it just knows kill zones and windows, right? So now coming into 9:30, you see price is still dumping off right here, right? All right, you see price is still dumping off right there, okay? So come to 9:30, price is dumping down. What did price do coming into this 9:30? So coming into the 9:30, see we came down, like we said before, came down below here, retraced back up into the imbalance, and then we started dropping down. When it dropped down here, right? So this was our retrace and then deliver, right? So when we deliver, what do we do when we deliver, right? We come down, right? We come down. Let's come over here. See if we come over here. See where we are. Let's do this right here. All right. Let me do this right. Let me go up in time. Try to get a little bit more meat on the bone so I can see exactly where we are. So right here, as you see right here, as we come down right here on this 9:30 candle, you see right there say low previous day right there, like low previous day. That's a prior day's low right there. Now let's go back to the 1 minute chart. Right, I really didn't even have to go down there, right? Right, because it's right over there. Pay attention to your own charts, Tim. So we had our we said this was our reversal, our retracement, and this was our deliver, right? What did we deliver to? What do we say where do we deliver? We deliver where, right? Somebody put it in the chat for me while I sip some high quality H2O. Where do we deliver to? Right? When we have our accumulation, manipulation, and deliver, where do we deliver to? Don't nobody know? Don't nobody know? Everybody just gonna sit there quiet? Man, if somebody don't say something, we fun shit in the live. I ain't even playing. If somebody, old lows, there you go. There you go, Shonister. Appreciate that. Old lows, right? So when we came down to that daily low, right, we started to offset the positions, right? The algorithm started to offset the positions. How do you know it started offsetting the positions? Because we got this little pop in price right there, right? So once we got down below the old lows, boom, we got that pop in price right there. There's your boom. There's your pop in price. Okay. So now looking at trading after 9:30. Now coming in after 9:30, right? You want to be aware of what's going on in price, right? So looking at price, what price is doing, I don't start trading to 9:30, Tim. So what am I supposed to do? Okay. So we start at 9:30 here, and we see that we had our we had our accumulation, manipulation, reversal, retrace, and then we came down here and we delivered below a old daily low. See, previous day low right there. We delivered below a daily low. How do we know we delivered? Because when we started offsetting those positions, we got that popping price right there, right? Got that popping price right there. So I see that we are in the expansion coming towards the delivery, right? So I'm not going to chase price. I'm going to wait till price hits my anticipatory reactionary point. What is that, Tim? This old daily low right there. It's a discount PD array on a higher time frame, an anticipatory reactionary point. When it hit the daily low, now that we got there, I'm going to wait for price to show me what it wants to do, right? I'm going to wait for price to show me what it wants to do. So now that we got here at 9:30, we get to our anticipatory reactionary point, right? What do? We come here, we go up, we trade above that short-term high right there, right? And going into the macro time, right? We're going into the macro time. What do? We come down and we take out the sell side. So we get what? Lejudas, right? Coming into the macro time, we get Lejudas. Why do we get Lejudas? Because we are offsetting from this accumulation, manipulation, retreat, this accumulation, manipulation, distribution, right? Accumulation, God dog it, come here, right? From this accumulation, manipulation, distribution below this low right there, right? Once we get there, right, we have us a short little accumulation, manipulation, and distribution below that low. How do we know we distributed below that low? Because we got this little pop in price, right? This time when we got the pop in price, what signatures are here? What are we looking for? We're looking for opportunities to participate, right? So when we come here, and we're coming there, we have this short-term accumulation. We push up above that high, and then when we come back down, right, we trade up into this imbalance during the macro time, and we displace away. When we displace away, what is this here? We have a bearish order block there. So if you're not brave enough, right, to take the short off of the fair value gap there after taking out the buy side, right? You're not brave enough to take it there. You have what? A break in market structure right here when we trade below that low, right? Break in market structure, fair value gap, bearish order block, right? During the macro time, we come down, we take out sell side liquidity, push back up into the imbalance, push back up into the bearish order block, push back up into the daily low. We're now below the low, so now we're anticipating it to be resistance because up here it was a discount PD array, but down here it is a premium PD array, meaning above price resistance, right? The weekly consequent encroachment of the wick. Up here it was a discount PD array. Down here it is a premium PD array, anticipating it to be resistance, trading back up into resistance, back up into resistance, back up into bearish order block, back up into bearish fair value gap. Price drop it like it's hot. Time and price. When did it happen? During the New York morning macro kill zone, during the New York morning macro window. Time and price. Higher time frame PD arrays, right? Anticipatory reactionary points. We get to it, show that we want to continue down, hit it as resistance, and drop it like it's hot. Right? I think y'all getting the picture. We've been on here along. Yes, and it was a bearish breaker. Shout out J-Rock. There is a bearish breaker over here also. I don't want to leave out the breaker people. So bearish breaker, bearish fair value gap, bearish order block, anticipated resistance, higher time frame PD array that we're below now, right? Below the PD array, anticipating it to be resistance, because Any PD array above price is a premium PD array. Any PD array below price is a discount PD array. We are now, I forgot to talk about this, right? We are now on the right side of the market maker sell model, right? On the right side of the market maker sell model. So price is in a sale program. So we're looking for discount PD arrays to fail and premium PD arrays to not fail, act as resistance. So discount PD array, daily low, come down, we hit it, break through it, it fails. Now that we're below it, act as resistance, right? Discount PD array fail, turn premium PD array, work. Consequent encroachment of the wick, discount PD array fail, return to it, work, right? In a sale program, bearish fair value, bearish breaker, premium PD array, it's above price in the sense of premium above price. Trade up to it, goes down, right? Bearish fair value gap, right? Premium PD array, meaning above price, go to it, come back down. Bearish breaker, order block, go to it, come back down. Up close candle, go to it, come back down. Up close candles, go to them, come back down, right? Up close candles, acting as resistance. Up close candle, acting as resistance. You're in a sale program. These are all signatures you're looking for to let you know that you're still on the right side of the market. And then you have a destination to reach to. Price old lows, right? When you trade it back up into this area, what did you leave? You left swing lows down here to trade back into, right? When you trade it back up into this area, what did you leave? Swing low there to trade back down into, right? When you trade it back up into this area, what did you leave down here? Swing lows to trade back down into. Higher time frame low, right? What is that? A weekly low, right? We get to the weekly low and we work the dookie out of it. Work it, work it, work it, work it, work it, work it. Get below it, drop it like it's hot. When did we start to move? Right? Let's see. What is this here? Bring this down, right, to the lowest point in price, right there. Oh, that right there is the afternoon kill zone, right? Afternoon kill zone. What time is this over here? When we're just kind of ranging, that is the lunchtime, right? That is the lunchtime right there. Okay. Time and price. Time and price. Time and price. What time do you watch the charts? When you figure out what time you're watching the charts, what signatures are you looking for? Right? Do you understand the power of 3? Do you understand how IPTA delivers? Do you understand market maker models? Do you understand what to be looking for? That's all I got. We've been on here for an hour and 58 minutes. Does anybody have anything for me? If not, we're going to go ahead and wrap it up. It's 9 o'clock. This is a 2-hour video. I doubt if anybody go back and look at this 2-hour video. I don't care if they go back and look at this 2-hour video because I done did my job. I put it out here on Al Gore's internet. Now, mentees, this ain't for y'all. Y'all come back and look at this video later after you learn how to read the price. Once you learn how to anticipate what price doing, then you come back and look at this and learn how to enter. Right now, you just supposed to be learning how to read price. All of you traders in the mentorship. When I say traders, I mean the ones that's pushing the buttons. Let me push the button, Tim. I'm trying to get $100 a day. Let me push the button. Look at Deborah Speller. Deborah Speller. Hey, everybody drop "That's My Baby" in the chat. Shout out Sherwin. What's up, Sherwin? Sherwin, all this time I've been saying y'all last name wrong, man. I've been saying spelling. It's Speller. Hey, man, that's it. That's all I got. I don't see nothing in the chat. I appreciate y'all for hanging out with me. Shout out Shonister for pulling up. Shonister pulled up in the chat. Appreciate that, Seawalk. Let me see who in here. Who all still in here? Y'all just drop a one or something in the chat so I can see who's still in here, because I don't feel like scrolling back through. If y'all want to download the slides, the link is pinned at the top of the chat. We got Lump still in here. We got Shonister up in here. We got Tish up in here. Here to Learn and Share still in here. FC, what's up, Felicia? I ain't seen you in a month of Sundays. We got Deborah up in here. We got Lulu. I ain't seen you forever, Lulu. I don't know where you been. Irma up in here. F Martina. I ain't seen F Martinez in forever. Wells J Rock up in here. Hey, Wells J Rock. Nah, you ain't Barack Obama. Barack Obama, somebody else. Yeah, Barack Obama would have a green name. So Wells J Rock, that's a different J Rock. You be watching the replay, Lulu. Father Legends up in here. What's up, Father Legends? Father Legends been doing his one too. Calio still up in here. Hey man, I appreciate y'all for hanging out with me for 2 hours, man. I ran my mouth for 2 hours. Hopefully, I was able to say something that resonates with somebody. Hopefully, y'all was able to take something away from this. If you wasn't, I promise you, I'm gonna try my best on the next time around to do something that helps somebody. Help somebody get an aha moment. Help somebody say, oh, that's what that means. Help somebody in some kind of way. I'll do my best the next time, man. But I want y'all to do me a favor, man. I was thinking about my brother earlier today, man. I got sad. I got real sad today. I was thinking about my brother earlier today. It was just before my mama called. My mama be calling us every day, and I appreciate her for that. Because I really wasn't taking advantage of talking to my brother like I was supposed to, right? And I was thinking about my brother today. I got real sad. And my mama called me, my brother, my sister. We was talking. I felt a lot better. But take advantage of the day while you can, man. Let the people that you know, let the people that you love know that you love them now, man. Don't just say it. Don't just show it. Say it, show it, and confirm it. Make sure that they able to receive the love that you giving them by finding out what their love language is. If they like words of affirmation, don't go over there and give them a shoulder rub. They don't like physical touch. If they like gifts, don't be going over there telling them, oh, you're doing a good job. They don't like words of affirmation. Find out what their love language is and speak in their love language so you can express the love in a way that they will receive it. Take advantage of the day, man. Ain't nobody promised tomorrow, man. Nobody, man. Go in the next room, hug your spouse, kiss your husband, kiss your wife, hug your kids, pet your dog, kick your cat, thump your turtle, you know what I'm saying, tickle the gerbil, whatever. If you got little furry little animal baby, show them love too, man. Show them love too, man. Take advantage of the day, man. Because ain't nobody promised tomorrow. Till the next time I decide to get on Al Gore's internet and share my thoughts on this thing that we call price action, it's your boy, Timothy Lee Rogers Sr., a.k.a. Araña Grande. Y'all see it behind me. Y'all see it on the shirt. That's Big Spider if you don't habla Espanol, man. Y'all be safe out here in these trading streets. I'm gone, man.